Good weekend, all. Ira Epstein of Linn Associates with your financial market wrap-up, and this is for Friday, the 3rd of December, 2021. It's your weekend edition, which means we're going to look primarily at weekly charts and try to get an idea of what the bigger picture looks like rather than the daily. We know how volatile it was this week. I'll tell you, I buckled in, had my seatbelt around me, and was not comfortable, not at all. I saw client balances moving like this. You know, owning a brokerage firm, you get to see everything. And it takes you to the brink sometimes because clients will take themselves where they shouldn't go. And you're going, oh my, what are we going to do with this? So been there, done it. There's a reason I have gray hair, had gray hair, by the way, in my 20s. And I was a natural towhead is what they would call it back then. And then it went gray. And if it weren't, it would be gray anyways from a week like this. But the nitty-gritty is the market's still fighting in many areas trying to figure out what goes on. Look at this monster rally in the bonds and the notes that we got. You would figure that with the Fed just now, what is it, today's the 3rd, so we're about a week and a half away from the next FOMC meeting when we're expecting the Fed to say we're going to taper, maybe not by 15 billion a month, 30. Who knows what the number is going to be to get this over and done with. Well, the market is saying, all right, if that's the case, let's change the curve yield, and that's what's going on. They brought up the back end and they're dropping. They brought up the front end and they're dropping the back end dramatically. So suddenly you're like their 10-year, you're back down to a 143 right in that area. Now, a lot of people don't think they'll stay there. This is the first step where they bring that in and then they move it in unison to the upside. There's other schools of thought that say, hold on. We got a lot of time between now and even June when so many people think the rate hikes will begin. What if the supply chains come down? What if inflation drops back? What if, like we saw with today with a terrible jobs number, I don't care what they try to make out of it, the number was bad. It was 219,000. It wasn't a strong number. The great news is the total unemployment rate, and they're measured differently, went to 4.2%. That is a pre-pandemic number. Very confusing. We're going to hear about that all weekend long as analysts write about it. So when you look at the monthly chart, and we'll start off with one chart of a monthly, you're backing off. It's only the first week of the month. You're down 0.63. If we go to last month, you did finish down 0.67 for the month. Okay. So from the peak of the market, and that's the highest close we had on a monthly basis, we're down just over 1.25%. Just a perspective. When you take a look at a weekly chart, each time this chart on a weekly basis has come down on a close and gotten back to the 18-week average, which it's not quite there. It didn't spend much time there, and it turned back up and it made a new high. Got to keep that in your perspective if the Santa Claus rally is going to happen. When we go to a bar chart, which isn't looking at just the closes, the pattern is one of a higher high and a lower low. So what the market did, not this week, but the week before, you had an outside week down and you got your follow through in it. You stepped out of the uptrend. The pattern from this rally to that, now you're in the correction phase. And from that right here to that point, you've got about a 50% correction in the market. Guess where the 18-week moving average of closes is? It's right here. So now the game begins. Does the market get under that and do one of these patterns again and move up? Or one of these when it just touched it in different areas and moved higher? I'm going to have my eyes all over it because it tells you the story is what to expect going just into the end of the year. This isn't about what's going to happen in 3 months from now. I'm viewing it, do we get the Santa Claus rally or not? And that's what I'm looking at real hard. To say that the market should have had resistance where it did, textbook. You know, this is when I'm ending my Cyber Week special where you learn for free if you wanted, taking my course on enhanced Bollinger Bands when I teach you about what this means and how you start predicting if the market, if it's going to drop, where might it go to, which would be, in this case, the 18-week average of closes. And it's just what happened. If you stay tuned at the end of this, I'll walk through the Cyber Week special, but it's ending today. So Higher high, lower low, neutral. Bias up, why? Well, if the market's over the 18-week average, I define bias as up. If it's under it, the bias is down. If the market were to totally let go from the upper band to the lower, this could be a target, but we haven't done that in months. So I have to assume the first target we're at. Until the pattern changes, it hasn't changed. When I look at momentum, this is typical. You lost the embedded reading, which means the market now either goes and re-embeds, needs 3 weeks to do that. That'll take it away from the Christmas time frame. So it's have to do it right away this coming week. And with that reading of 69, it'll be very hard to do it. Or more likely, it corrects an overbought condition, because when you lose an embedded reading, you instantly get overbought and then you have to come down, a bullish embedded reading. If it were a bearish one, you instantly become oversold and then have to correct out of that. Not looking good, let's put it that way. Same thing in the NASDAQ. It didn't embed here, just got overbought, and it's correcting the overbought. Again, the support right there. And if we walk together on this, each time we've gotten back into that number range, the 18-week average, it has held and gone up for another high. That's what I'm pointing out. The Dow and the Russell have not done that. The Dow and the Russell have sliced through these numbers on corrections and gone to the lower Bollinger Band recently. They changed their character back in September, and you did the same thing back here even earlier. So don't apply the same thought process I have for the S&P and the Dow to this. These charts are wild swinging from highs to low in Bollinger Bands. They're already oversold here. Same thing here? No. Still momentum down, but the odds of staying under a Bollinger Band for any length of time is only 5% of the time. So I'm looking to see, does the market find its legs? How's that for the word right there? In the 30-year bond, you have a pattern of higher lows, higher highs. It's very interesting. As the market came down here, I recall speaking with you, and these videos are up there on YouTube, that you often find major support at the 200-day average and especially a Bollinger Band, but the market found its way with it right here. It got under it, then it fought against it. So I'm looking for the support there. I truly didn't think you were going to get this, where the market just kept coming up, watch, into a run. You might be going right back up here. You're overbought, the trend is up, the bias is up, support 162.14 for next week. 10-year notes, a little different now. As you move along the curve yield, it changes. The resistance is the 18-week average. You never did embed. You're correcting an oversold condition. You have a pattern of a lower low, higher high. I don't call that a trend, but here too as well. The combination of the lower Bollinger Band and the 200-week average of closes held very well. In the dollar index, on pullbacks, I'm still looking for support first. You have an embedded reading. It's when the two numbers that make up the slow stochastic go sideways over 80, and that's what you have. Number two, the market's about to get an attempt this week. I think when we open Sunday, that's when we're going to see the first shot at it. Can we get the 18-week average over the 100? They're going to come together here. That I can see this week. Does it get over it? And then the next number to fight would be the 200. But as the market slips, let's assume I'm right and it slips. You've got layers of support with these three moving averages in the market. But what I think will rule the day is as long as the red line doesn't close on a settlement basis at the end of the week. This is a weekly chart. Under a 79, the bias stays to the upside and momentum to the upside. The eurocurrency had been running under the lower Bollinger Band. It's moving to the right-hand side. That's what it's supposed to do, but it is very bearish. It is still with an embedded reading. So until the red line closes back over 21, on rallies in this market, I'm looking for the pros to sell. You had a bearish crossover this week where the 18-week got underneath the 100-week. The next target is the 200-week. If the market were to rally, you can see there should be a lot of moving average resistance at those numbers. In the Canadian dollar, the trend had been up in the terms of higher lows, higher highs, but you've actually for about 3 weeks now been underneath the 18-week average, and that's put pressure on the market as you keep drifting down. You are getting oversold. They had in Canada a phenomenal jobs number today. 3 times what the trade was looking for in a small economy like theirs. They got 150, I shouldn't say economy, in a small population base like theirs compared to ours is the right word. They got 157,000 new jobs. We got 219 or something. That's impressive. And but it still didn't do much to lift the market at the end of the week. In the Japanese yen, the market had been down. It has turned back up. Momentum's up. You don't have a trend up. You're no longer in a downtrend. That ended, to be honest, right here. This whole swoop down, when you got up there, you came back down for a challenge, and then the market took off again. So now the question is what to do. The weekly chart isn't giving you any picture at all. Bitcoin looks to me like on a weekly chart, it's going into the 52,877 level to make some decisions. If that doesn't hold, you always got to be scared that you go to a lower Bollinger Band, but the first support should be that 18-week average. The differential between Brent and WTI, well, you got up to the 457 level, and now you're back to 362, so they've narrowed it in by $1 a barrel, basically. The difference this week, and as you know, OPEC put out that 400,000 barrel increase for January. The market, it could have gone either way. I think they did the right thing. I think that they took the strategic barrels off the market. I think they showed statesmanship. They can always pull back. It was a smart move. I didn't think they'd go for it. I think that I really thought they'd go the other route because I think they were aggravated when they saw the U.S. grab its allies and they're all going to relieve strategic reserves. What would amount to 2 days of production? It was more symbolic than anything. I think they read through that and got it. I mean, it's their supplies that matter, but you do understand Goldman Sachs, JP Morgan, Bank of America, their analysts seem to all think, everything I'm reading, that we're going $100 plus oil next year because we don't see in the world. It's our shale areas, the government stopping drilling on federal lands, that's America, but they don't believe OPEC has the production facilities to really increase what the world's going to need, especially if Omicron becomes not a big deal, becomes the dominant vaccine, and we can get vaccinated to protect ourselves, economies will come running back. That's what people are wondering now. When you get to the Brent, we knew this was going to be a rough week. Everybody worrying where you're going to go, and it happened. You were down 3.9% for the week. I don't look for it to have legs beyond the lower Bollinger Band into these moving averages. In other words, I think you're coming to the end of the break here. I think that'll be the case in the WTI. I think these will be very important numbers, assuming the world economy stays strong. Gasoline, well, let's give President Biden let's give him an applause. He broke the market. Since he did this last week, he started talking about a break in the marketplace. You've been coming down since the 19th. And he was releasing the reserves. He came out. Now look where the price is. That's a 4% break, an 8% break, and another 3%. Any way you want to cut it. I don't care if it's accidental, it just happened to be, or he engineered it. He did it. That's on him. That's a good move. So you put it all together, you try to come up with ideas. And here's the idea. I offer every now and then a Cyber Week special. It's not often. And during that, if you subscribe to a 1-year subscription to any of my research programs on SPDRs, ETFs, futures, or my whole futures package, they start at $156. You can take my charting course where I teach all these studies. I think you'll love the way it's done. It's about 50 videos, 8 hours of videos. I build on everything. I've taught a long time, so I think you'll appreciate the teaching method. Or if you've already taken that and you want to take the Enhanced Bollinger Band course, you take that one. I'm going to show you how to tie together things in Bollinger Bands I don't think you've seen before. I can't guarantee it, but I doubt it. Any of my research packages, each one starts with 24 videos a week. Each video about 20 minutes long in the mornings, and then I kick you up if you take other packages with writings, special reports, and so on. How do you get to it? Because it's not on the website. Just take your cursor, move it up, click it. You'll see an icon. At that point, just fill it out and away you go. I wish I could tell you call my office, but the sale will be over by the time you call the office because it's the weekend. So it's all explained there to begin with. You have a great weekend. I'm Ira Epstein.